Hello everyone, welcome back. The Fed just crashed the stock market. What can we do now? Is it the end of the day? How to play safe right now? Stay tuned. Today, we will talk about what is the Fed going to do in the next few months. How many rate hikes going to happen this year? What is the market really scaring about? And which ETF and stocks are going to perform well? Okay. In the beginning of the year, the market only expects 3 rate hikes, one in March, one in June, and one in September. And then January 13, the market expects 4 rate hikes. But right after the Fed meetings, the market expects 5 rate hikes this year. As a result, the market dropped a lot. And right now, the yield spread between 10-year and 2 years is just 0.6%. Is pretty level. So if the Fed increase 5 times, then the yield spread will be negative. In the past, 2018 and 2019, during the quantitative tightening period, the S&P 500 going to drop in the beginning of the year and then go sideways for a few months and then rise and then drop a lot at the end of the year. And this year is also a midterm election year. You can see that the market's usually pretty weak during January and February, and then rise again to April, and then goes down again and then sideways, and then rise again in October till the end of the year. This year, the market seems to follow the midterm election cycle. Right now, the Nasdaq 100 already dropped 12%. On Friday, it's trying to rise again, but it's still at the resistance level. If it cannot hold in the next few days, it may drop again to 13,000 level. Right now, only 35% of the stock is above 200-day moving average. The Nasdaq advanced decline ratio is 3 to 1. The volume advanced decline ratio is 4 to 1. It's pretty good. Right now, the VIX level is below 30. The market's kind of calmed down right now. And the Russell 3000, which represented the 3,000 largest stock in the stock market, is also stay above the support level. And most of the stock rise on Friday. During the past week, energy and technology is still positive. Look at the software stock. It can stay above the support level, so it's a good sign. The market may try to bottom. For electric car stock NIO, it's also trying to find a bottom, see whether it can find a support at this level. Upstart is also trying to do a support here. DDOG, one of the star stock, is really volatile, but the stock is trying to build at the support level as well. It still stay above the gap up level, so it's a good sign. Because if have undercut here and then rise back, the markets expect that the real GDP is still growing 3.5%, so it's still pretty okay. The ISM Manufacturing Supplier Delivery Index is dropping, so the market expected the transportation cost is kind of decreased. But for the World Container Index, it's still rising, so the inflation level may still be at a bit high level, not totally decline. The market expected the earnings increase by 9% this year, so it's much slower than last year. At this kind of situation, I suggest that most of the people use barbell content strategy to invest. This means most of your investments should be in the safe asset. Only put a small amount of asset in the high risk class. One of the best stock right now is MDRX. It's breakout last few days and stay above the breakout level because it's trying to buy back the stock. Another stock is software stock, GNXC. trying to break out as well. In the next few days, see whether there is a pullback to the last support level at 187. It can be a buy. The market really scared about Ukraine and Russia going to have a war. Oil price in US is already $86. It's already break out the support level and stay above it for a few days. So the inflation maybe still stay at this level. The energy sector is the best sector in the market right now since the beginning of this year. This is a smaller oil stock, OVV. Look at the price action during the last few days. It's trying to drop below the 50-day EMA, but it stay above it. And then right now it's prepared to break out again. It's expected to earn about $8 this year, compared to 2015, which is the same oil price at this year, $80-something. So you can see that it can earn a lot of money if the oil price stay the same. So it's a good buy right now. Another oil stock pretty similar, MGY. They pretty similar to OVV, the price action. It's also prepared to break out tomorrow. The expected earning is $2.65. Look at the earning growth. It's huge. If you do not want to invest in US, this is an Indonesia telecom company. During the market crash in the US, it's extremely strong. It's a company from Canada, Arisia, symbol ATZ. Its earning growth is over 70% because its online sales is performing really well during the last few quarters. So even the market crash or not, it still keep at the high level. So if the market can stable this week, this is good buy. For this week, Marriott is also performing really well. Even though it's dropped a bit, it still stay at the support level, 152. Because the Omicron is not as strong as previous variant, hotel stock is performing pretty well. So I bet that if the market can stay strong, Marriott International can perform well. Another chemical stock, CF, it retreat to the 50-day EMA, go above it in the last few days and stay at this level. So if it can break out this level, $72, it is a good buy. BCC is a wood company. Even though the market kind of crashed, it still stay above the support level, $70, and stay above the 20-day EMA and 10-day EMA as well. I bet that it can perform well if the market becomes stronger again. Since this year is really volatile, you guys can choose to invest in those companies that has a lot of free cash flow, like COWZ ETF. Today is below 50-day EMA. This ETF are kind of stable. If it can stay strong above this 30-week moving average, it can be a buy. Another one is SCHD. It invests in US dividend equity. It's pretty much the same as COWZ. So if the market's kind of stable again, it's a good buy as well. Okay, please like, share, subscribe this channel, and please leave a comment if you have any questions. See you guys next time.